Okay, welcome, David Wall. Thank you so much for being with me today. I want to start it out with a bit of an introduction. You're with ClearBridge Investments, which is now part of the Franklin Templeton family,
Yeah.
but wanted to give folks an idea of how you got to this spot. After about 3 decades in the business, you have a BA in economics and an MBA from the University of Western Ontario. Correct me if I'm wrong here, but I think you've been based in Ontario for your entire career. You've held senior
I was
positions at
actually
TD.
actually John in the US for 2 or 3 years, lived in Connecticut when I
Okay,
first joined the Legg Mason predecessor to ClearBridge and being part of ClearBridge and Franklin Templeton. So I
right.
did
That's
spend
the
some
group
time
at
in the
Rare,
US.
right?
Pardon me?
That's the group at Rare Infrastructure where you were?
Yeah, that's correct. And I was
Okay.
the representative for Rare in the US, which became part of Legg Mason. That's right.
Okay. And so then
Yeah.
of course Franklin Templeton took over Legg Mason. That's how that worked.
Yeah,
Okay.
it's a long history of how I went from being part of a national sales team and running sales at CIBC to coming back as part of ClearBridge. But that's for a different, we'll need much more time on a different podcast for that. But
Yeah, and that's where we met a million years ago when you were at CIBC Asset
yeah,
Management.
yeah,
And in my time working for Franklin Templeton, which seems like a long time ago now, it's more than a decade ago. But I appreciate you being here with us.
yeah, good to
I
be
wanted
here.
to talk about the fact that you do have 3 decades in this industry across multiple cycles. What's unique about the current market environment compared to past inflection points that we've seen?
Yeah, and it's a good way to start. The 3 decades isn't a great way for me to feel about maybe how old I am in this business, John, but I appreciate that acknowledgement.
Sure.
This moment feels just a little bit different because of the convergence of multiple transformative forces. We're seeing, strong corporate earnings. There's abundant liquidity, and that's typically signaling confidence. But if you overlay that with, rapid technological disruption, especially everybody's heard lots about AI, and a global push toward energy transition, and you get a much broader, I think, probably a more structural shift and really unlike past inflection points that were often, they're cyclical or policy driven. This one is probably, it is reshaping entire industries and investment frameworks, I think.
Yeah, we've seen a lot of resilience in 2024 and deep into 2025 already. So what's the mood among institutional investors that you're speaking to? Are we seeing caution? Are people conflicted about what's going on, or what? Any optimism, maybe?
Yeah, I don't probably have the best answer for you, but it's a mixed bag.
Yeah.
And I think that's what's going on not only institutionally, but from a retail perspective as well. There's genuine optimism around earnings resilience and the labor market strength, although, that comes and goes a little bit. But I think it's really tempered by caution around rate policies, what's going on globally. There's a ton of geopolitical tensions going on. And I think many investors are conflicted. You want to make sure you participate in the upside, but very wary of downside risks. And that's why we're seeing probably a pivot more so these days towards quality, diversification, more defensive positioning, even though risk appetite does remain intact. I found a funny story. I read a study about 68% of institutional investors in the US believe the S&P 500 is overvalued, but they all will continue to invest in it, which I found pretty interesting. It's kind of the mood of the day as kind of going to that. It is a mixed bag kind of story, but fear of missing out is really driving some investment right now, I think.
Yeah, that makes sense. It's probably the same on the retail side. It's a total mixed bag. People are
Yeah,
everything from overly optimistic to highly skeptical. It
yeah,
kind of depends on your demographic a bit.
yeah,
I had
likely.
conversations this week with people that are, within that 1 year of retirement, and they are really full of nervousness. So yeah, it's interesting. So how do you balance at ClearBridge the optimism around earnings growth with these structural risks like inflation, debt, and of course geopolitics that has captivated us all in recent years?
Yeah, I think it's no different than what you're probably trying to get your clients to adhere to and to kind of subscribe to, and it's just by staying disciplined. Our focus is on companies as it is in your book as well. Strong fundamentals that can navigate inflationary pressures, geopolitical uncertainty without really compromising that ability to participate in growth. At ClearBridge, we also lean on a capital markets team, and they produce something called the recession risk dashboard. And really, from our perspective, it looks at 12 variables that we think most closely indicate the health of the U.S. economy, and that in and of itself continues to signal expansion. but we're not complacent. We're actively monitoring all of those leading indicators and using inflation protection assets, sector diversification to hedge against structural risks. No different than I believe you're probably doing in your book with your clients.
Yeah, that makes sense. ClearBridge clearly has a reputation of long-term, high-conviction investing, and so what you just said makes a lot of sense. How does that philosophy play out in practice then when markets are really volatile and the headlines are noisy or scary?
Yeah, well, as you know, volatility tests conviction, that's for sure. But you know what? We believe it also rewards it, and I think history shows you that. And our approach is really it's built on deep bottom up research, a long term mindset. Like you said, we don't chase trends. We invest in those durable businesses that can compound value over time. But in volatile markets, we stress test our holdings as well, and we rebalance thoughtfully. We look for dislocations to create entry points. It's really about being that patient but prepared investor, and it does at times have moments of underperformance on a relative basis, but as we believe over the long period of time and over a cycle, you do well during that period.
Okay, so you're not necessarily trend followers, and I mean, everyone's really focused on AI, but what are some of the thematic areas ClearBridge is emphasizing right now? Is that dividend growth, infrastructure, or more innovation plays? Anything that you can talk to there?
Yeah, I can. It kind of encompasses all of those. I mean, we're focused on themes that offer both resilience and upside. Dividend growers provide a cushion in uncertain markets, and we've seen that versus in the U.S. at least the S&P 500, the dividend growers are starting to outperform, and once they start to outperform in these kind of periods of uncertainty or volatility, you get very high quality names, and really you're looking for those companies that have financial strength and are able to weather the storm of volatility. Dividend growers do that. I think infrastructure is at a multi-decade opportunity. It's inflation sensitive and tied to secular trends like AI and decarb through a large scale, either through established utilities where the growth rate has gone from 3 to 4% to 8 to 10%, depending on what region you're talking about utilities. And also, the renewables that are an important part of energy self-sufficiency going forward. So those things are really, they have that downside protection, but you can still participate in the growth. Innovation, also a key, but you got to be selective, as we've all seen. We want companies that are monetizing that technology and AI, not just riding, tremendous investment and hype. We want to make sure that we get those ones that can monetize and broaden out in different industries, different sectors, other than just the tech and AI side.
Yeah, that makes sense. I love how you use the phrase "weather the storm" because my team hears me say that so often that they're
Yeah,
sick of hearing
yeah,
that.
I bet.
But it's extremely important, right? If you're in a storm and you're on a perfectly good boat, don't jump off the boat. Just keep on going. Moving on, I remember my days back at Franklin Templeton. I have my own pitch for why being part of the Templeton's broader platform allowed me to do what I wanted to do. But how has that
Yeah.
worked for ClearBridge now being part of this broad asset managers platform? And does it enhance what you can offer to investors with how massive Franklin Resources has gotten now?
Yeah, I think so. I think it's really been a game changer. ClearBridge, although they had a very good and still have a very good independent central research team that's based in the US, upwards of 20 people now on that team. We now have access to global research with, much broader asset classes, deeper ESG integration, and that really allows us to build, better customized portfolios and tap into those insights that might be beyond the US and beyond geographies that we have been in the past and sectors. It's really strengthened infrastructure and thematic capabilities, and also, helps deliver more holistic solutions to clients. I'll be practical here as well, John, from a practical perspective. The sheer broad depth of the sales team and the relationship team across the globe from FT, it's really opened up our investments, aside from the strength we get from being part of that Franklin Templeton and Franklin Resources group. It's really it's opened us up to a broader global audience and really helped us reach out to more clients on a global perspective.
Yeah, that makes sense, right? Like
Yeah.
you think if you need an analyst on something that might even be obscure, there's probably someone at FT that you can call. You don't have to go for outside research necessarily.
Well, absolutely. And I'll give you a cool example that the infrastructure team who I started with way back in my CIBC days, the infrastructure team and the utilities research team in the US and or the Canadian equity team in Calgary, they can share ideas around pipelines, utility strength, what are you seeing, who are you visiting, and those walls of you can't share ideas has gone, and now you're able to really talk out and get maybe a deeper understanding on certain sectors or certain even names that you didn't understand originally. So it's been really, really, I think, beneficial and accretive to ClearBridge.
Yeah, extremely valuable to you as
Yeah.
managers to be
Yeah.
able to not have to go outside the shop to understand what's going on in a market. So
Yeah.
let's talk about individual sectors. Where are you seeing durable earnings strength, and where do you think expectations might be potentially getting ahead of reality? Because there's certainly a lot of talk and use of the word bubble in the news the last few months, right?
Yeah, yeah, there is, and we're seeing in the traditional sectors that you might think. I spoke about it. We've talked about it a little bit already on the infra side. Sectors like utilities, infrastructure, industrials as well, can really benefit from the long-term investment cycles and policy tailwinds. These are less dependent on consumer sentiment, more tied to structural demand, especially on the infra and the utility side. You're not GDP leveraged as much, so that you do have a little bit of shelter to that. And I think, maybe we can talk about that later on in the discussion. But on the flip side, some mega cap tech and consumer discretionary names are really right now they're priced for perfection, and we're really cautious there, and that's where that strict discipline of not only valuation and not only getting into a name but selling the name, and price being an important point. When you hit your price, it's time to maybe exit the position.
Yeah, it's really interesting how there's almost a 0% chance priced in of recession in the US next year. There's always some single digit percentage based on the market being a little bit bearish, but right now it's really wild.
It
So
is.
as we look at central banks changing into the next rate of their policy decision kind of cycle, how does that shift ClearBridge's outlook for what we're going to see from equities and from income producing assets?
Yeah, another great question. And, it does create maybe a transformation on the investment cycle. But, with rates likely peaking, and that's both in the US and Canada, we're now probably in a rate cutting cycle for the foreseeable future. Albeit Canada and the US probably at different stages, and we are at different stages, but the landscape is certainly shifting. I mean, income generating assets, again, I go back to this theme that I'm talking about, infrastructure utilities are becoming more attractive, especially given those inflation linked cash flows. And, they're becoming higher growth names, and that's tied to data centers and the demand for energy. And like I mentioned in a previous discussion we just had, they used to grow at 3 to 4%. They can now be 8 to 10%. And, we're also revisiting interest rate sensitive sectors like real estate, where valuations have certainly reset, and there's selective opportunities that are coming to the forefront. So it's probably a good time, as I'm sure you've been talking to your clients, to reassess maybe duration and a little bit of that income exposure that clients have and investors have.
Yeah, there's a lot of this conversation going on because, like I said at the beginning, it is a mixed bag of feelings
Yeah, it
towards
is.
what's going on in the markets.
I agree. And
We've been really well rewarded for being extremely short duration on these income producing assets. But like you
yeah,
say, we have to start analyzing maybe we should be taking longer duration. It's tricky because the majority of the people that have the money in North America are in retirement. And
right.
you go, not only are they in retirement, but they also have a much longer potential life in retirement than their parents or grandparents did, right? Like I use my own granddad as an example all the time. He was a good war veteran, retired and was passed away just single digit years later. And so it was not a drag on CPP, didn't have to worry about saving for a long time. But a lot of retirees now, you could potentially be 45 years in retirement,
I
and they
agree.
can't they can't just sell out of their equity positions. They need that inflation protection. So
No, and we're starting to see, in the US especially, John, there's $7.5 trillion of cash on the sidelines. And how does that get back into the market? And when it does get back into the market, will that be accretive to valuations? Probably, for sure. How does it get back in the market? Well, rate cuts might help with that, but also, when you have short-term investments that we're paying, I don't know, an ultra short bond fund, maybe 4 is now 3.3, maybe goes down under 3. That's when you start looking at other options. And like you said, your retirement, you hope, is 20, 30, maybe upwards of 40 years now. You can't just rely on preservation of capital. You need some growth in there. And I think that infra utilities, you know, dividend growers, those are some really good opportunities going forward.
It's amazing, how some things change and some things stay the same. This cash on the sidelines discussion is one that we probably had 12 years ago, coming out of the GFC when there was like
Yeah.
3 or 4 trillion in bank accounts. I often think about today's where we are in a market cycle. It feels like it rhymes with like somewhere in the 2012 to 2014 timeframe where you're like, yeah, I know there's more juice to squeeze out of this orange. I don't know where it's going to come from, but there's so much cash on the sidelines.
Yeah.
If you get a pullback, how is this money not going to move into the market? It just seems
Yeah. And
so.
the interesting part to that, John, is that our investors with all that cash on the sideline, are they becoming valuation agnostic? Are they not, are they buying on the dips? Should they be? Yes, they should be. Are they? Maybe not. And so you need that impetus to go in, and maybe it is that rate cycle you get on the income side that isn't satisfying anybody anymore. Maybe that's when the money starts to roll off the equity sidelines and go into maybe more not total risk, but a little bit riskier asset to get more return.
Yeah, and maybe that takes us to the next thing we should talk about is the rotation between growth and value, because value has been absolutely crushed. If you look at Canadian pipelines, U.S. energy, these big solid names that are building cash flow haven't been very in vogue. Are we at the beginning of maybe a new cycle or a rotation into that, or are we still like in transition phase where we don't know where it's going?
Well, we think we're in the early innings of a rotation toward value and cyclicals as inflation cools, rates normalize, earnings growth is starting to favor sectors that were previously overlooked. Obviously, it's not a black and white. It's not a binary shift. Growth still has a very big role, obviously, but the market is broadening out, and we think that's pretty healthy. We're positioned for maybe, in our part, a more balanced cycle going forward. But again, I might refer back to the recession dashboard that we use and some of the statistics that we get from that. And when we look at it, any time in history when value has underperformed growth by 25% or more in a 12-month period, the next 2 years, value 100% of the time historically. Now, can't hold me to that as a guarantee, obviously, John, but in history, 100% of the time, when we have that happening, and we had that happen in the US in the first quarter of 2025 this year, value does outperform, and it always outperforms. It can vary on how much it outperforms, but it does. So is it a transition from growth to all value? No, but history shows us or tells us that anytime we get that scenario in history, we have a good chance to have value as part of our investment mandate and maybe cycle into a little more value, and outperformance does usually happen over that 2-year period.
Okay, so you are I'm sort of going to label you as an infrastructure guy because you spend so much time in that space, but infrastructure often flies under the radar for everyday investors, maybe because they think it's illiquid or they don't think it's sexy to invest in an airport or a bridge or something. What makes it a compelling allocation in portfolios today?
Well, and yeah, I'm not. Listen, it doesn't hurt my feelings to be labeled an infrastructure guy because over the long period of time, I think infrastructure investing, at a portion of your mandate, does you well. So listed infrastructure, which I'm guessing you're speaking of, I don't want to presume, but listed infrastructure, it does offer an opportunity for both the manager to have a difference in time horizon. It does give the manager liquidity on names, but it also gives the investor opportunity to get in and out. You don't have to lock in money for 5-10 years as some of the very big private investment groups or private investment on real estate or infrastructure allow you to do or make you do and lock your money in. So you get liquidity both as a manager and as an investor. But it really, infrastructure offers kind of that unique combo of stability, income, and long-term growth. It's tied to essential services, which is power, transport, utilities. It benefits from secular trends like we're seeing in AI and clean energy. Renewables is a big part of infrastructure mandates now. And for everyday investors, I think it's a great way to reduce portfolio volatility while getting to participate in some of that change. It's a stable, predictable income and growth in times of volatility. The great part about it is that the correlation between GDP and GDP sensitivity is much less than a common dividend paying name. So it allows investors to participate in healthy yields and grow and get the growth of the name as well. The best part about infra, in my mind, though, John, quite truthfully, is that over the long period of time, for you to invest in something that has these defensive characteristics, it's non-correlated to the market, you don't have to give up growth in the portfolio by investing in that sector. So for me, and I'll take that moniker of being an infra guy, I think it's an excellent investment and a really good time right now to invest in it.
The ability to not be locked up to something for 5, 10, or 15 years is also really appealing to the average retail investor.
Right.
There are still a lot of products out there that relatively wealthy retail investor could get into, but that still have 4 to 7 year lockup periods. But with the advent of pretty liquid products, even just a monthly redemption schedule is really an amazing invention on the infrastructure side. So yeah, I think having a little bit in the portfolio makes a lot of sense.
It does. Listen, it used to be that only the wealthiest people in the world, or the largest, like a CPP investment board, they were the only ones that could really participate in the benefits of infrastructure. And now with some of the products you're talking about, even listed infrastructure, you get that same characteristics, with small time investments. So it's good for all of us, including, you and me.
Yeah. So we're seeing some enormous investment in energy transition and, of course, digital infrastructure. Where are some real opportunities, and where's the hype maybe running ahead of fundamentals that you see?
Yeah, we're seeing really exciting developments, and this is starting to be a theme in some of the answers I'm giving you in electric utilities and modernizing the grid and renewable energy scaling up, and that digital infrastructure supporting AI and cloud growth. These are attracting massive capital, and they're getting policy support, which is incredibly important if you're going to make those investments. And companies that are enabling some of this transition and not just participating in it are where we see the strongest growth potential. These hyperscalers that are asking for enormous amounts of energy and securing enormous amounts of energy are really enabling some of the utilities to lock in growth rates, like I'd said before, that are really haven't been seen in the past. And it's not equal utilities all over every sector, every region. It's more in certain select regions where you can pick those utilities out that are really those opportunities for really participating in energy transition and that new digital infrastructure that you're speaking of.
It's got to be weird for the folks that actually work at these companies, hey? Like the company just basically doesn't grow for their entire career, and then all of a sudden the hyperscalers come out of nowhere and they're like, hey, we need you to grow at 10 to 15%. And these guys are going, what? Growth? That's not in my vernacular.
Yeah, and the beauty of it is, and what we try to do in our infrastructure mandate as well, is you want to look for a utility gets paid on their rate asset base. So the more you invest, and you want those utilities that are investing, the more you make off your rate asset base. So the regulator allows you to invest, which allows you to put money in and make more money off of it. It's really a unique business that not everybody understands, but everybody should take a look at. It's really something right now. It is a unique time period for utilities.
I had a question about how does infrastructure help smooth volatility, but I think you've really answered that. The income that it provides gives a lot of long-term stability to a retail investor. So I might skip past that and get actually into...
Let me just add a couple of things to that, John, that I probably didn't mention. It does offer predictable cash flows. We've talked about that. They're linked to inflation, they're resilient in different rate environments. They really provide those steadier returns and lower drawdowns during market stress. And part of that is because whether it's the utilities or regulated utilities where there's regulatory oversight, or some of those airports, et cetera, that have concession contracts that tell you what your allowable return is and what you're going to make in all areas. It tells you how much you can increase prices or rates during inflationary periods. It allows you to pass through extra costs in an environment where costs are going up. So all the other things I spoke about, there is the regulatory or concessionary based contracting that does allow for that smoothing as well and reduces the volatility. I just add that. I know that's longer than just 1 minute, but I think that regardless of GDP, you get those things.
Yeah, that's okay. I mean, the more explanation around this, the better, I think.
Yeah.
Going back to kind of the first part of our conversation, outlining you've been in this business a while, you've seen a few different cycles. What are some of the most common behavioral mistakes that you see investors make? Because we're kind of at that stage in the market where people can make some of those common mistakes, right?
Yeah, and we all can, and obviously emotionally based, as I'm sure you're well aware, and part of the battle that you go through with prospects and clients as you're working with individual investors. But I think momentum chasing is a big one,
Mm.
especially in tech. There's just that FOMO going on in markets right now. There's a fear of really missing out. We all know that we're in very highly leveraged multiples for some of these names, and yet they continue to roll forward and momentum carries them forward. So we still continue to chase that. And I think that the overconcentration in a few of those really high flying names can make portfolios vulnerable. And, the best advisors don't allow that for their clients. I think the best portfolio managers and investment managers don't do that to their portfolios. I think another one is another mistake is underestimating geopolitical risk or ignoring some of the big macro shifts. So what we try to do as a manager, an investment manager, we try to advocate for discipline, that continued diversification, focus on all the fundamentals that you try to stick to, even during those times when it becomes very hard and trailing the benchmark because you're underweight some of those high flyers. But, we try to avoid that short-term noise and stay aligned with long-term goals. And I think that applies to management, that applies to individual investors, it applies to the retail side as well.
Yeah, the under and over concentration thing is so crazy when you're in a raging bull market. And like from a
Yeah,
risk management
it is.
standpoint, we're in earnings season now, and the big name, of course, is Nvidia, close to the end of earnings season. And if I have clients start coming to me at Christmas time saying we got to pile more money into Nvidia, I am not going to be very like well slept over the holidays. It's going to be one
Yeah,
of those things like, how toppy are we?
and that's where that good advice and professional advice and good advisors, that's where you earn your money. Sometimes it's not when things are going down, it's sometimes when it is when going down, and you don't want people to bail out of the market. But it's also when things get frothy, and you caution on diversification and that 5-year time horizon, which, as you know, John, 5 years is becoming not, it's a lifetime in investing now. It's not, it was the normal time horizon when guys like me got involved years ago. You only got a quarterly statement. And I think that helped investors. Now, you can go on hourly and find out what some of your investments are doing. And I think it's harmful to the psyche of the investor.
Yeah, it'll be interesting to see if this proposal out of the US to take quarterly earnings and make them biannual earnings actually takes hold. Because, yeah, who knows?
Yeah.
So how do advisors and investors then stay focused on those fundamentals when the news cycle is designed to provoke a reaction? The media is putting things out there in order to create fear so that you put eyeballs on it. How do
Yeah.
we stay
Well,
focused on these things?
so frameworks for us are key, whether it's our recession risk dashboard or recession dashboard that we watch all the time, whether it's the valuation models that we stick to when we do sector screening. I think it's all about having a consistent process that helps you cut through the noise. As we all know, whether you're a professional investor as a portfolio manager, whether you're just an investor doing it yourself or hopefully working with an advisor, you got to you got to cut through the noise, and you really have to take emotion out of it. And I think regular rebalancing, revisiting those investment themes and investment policy statements, also try to keep people aligned and portfolios aligned, because the headlines are always loud, but fundamentals are what's going to help people over the long term and drive those long term results. But not easy by
Yeah,
any
that's
stretch of the
that's a
imagination.
great message for long-term investors right now, right? Like, can you boil something down into one message, or is that just too hard to say to an investor?
No, no, I think that's right, and I think you can boil it down to stay the course. And
Yeah,
once you have a
okay.
plan in place, and you have an agreed, this is what we're hoping for, and this is what we need to get us through retirement. And if we're hoping to focus on a 6 to 8% return, and I'm making this up, John, as we go for illustrative purposes,
Yeah.
that if you focus on the 6 to 8, and all of a sudden the world's getting 30, realize and go back and say, but we only need 6 to 8. So we don't need to chase that 30, because we certainly don't want to get minus 10, and we'll be satisfied with 6 to 8 over the long period of time. So
Yeah.
um, I think stay the course. The world's evolving rapidly. There's all kinds of new things that are leading the way. But if you look at 20 years ago or in the early 2000s, the top 10 names concentration wise in the S&P 500, there's in the next 23 or 24 years, 5 have had negative returns over that time period. So what happens today isn't necessarily what's going to happen tomorrow, and you stay your course, and I think you'll be in really great shape.
Yeah, don't let FOMO mess up your plan,
Yeah, don't let
right?
that short-term volatility derail that long-term plan that if you stick to, it's important to stick to when times are really good because that'll help you through those times that are a little bit more troublesome.
Right. You're not Tom Brady. You don't get to call audibles. You already have a road trip plan here.
Well, not audibles, not audibles that work as many times as they did for him anyways.
Exactly. Okay, so you've worked with some of the biggest names in Canadian asset management over your career. What's a lesson or maybe a habit from early in your career that still guides your thinking today?
Yeah, and that's a great question. For me, even though I have got a chance to work with really good investment managers all the way through, I take a look at what they do and how professional they are, and I kind of take that to my own world, John. And full transparency, I do not what money I do have and what savings I do have, I do not do it on my own. You would think that someone who has as much access to information as someone like myself does. I don't do it on my own. I have two very good friends who I trust and have worked with for a very long time in the business. They make the decisions, they make the allocation decisions, and I really think that professional advice, and for me, that's how I do it. I don't trade individual names. I rely on other people to do that. I'm predominantly using managed money. I rely on others to make those manager decisions. So I think that that's what I've learned over the long period of time. Get professionals to do it, and as much as you can, take emotion out of it. I had one friend that I work with. He said to me during the COVID crisis and what went on during that period, the hardest part for him was to try to keep people invested. Him and I didn't make any changes to my portfolio at all, and mine was one of his best performing portfolios over the 5-year cycle, taking COVID, both sides of COVID out of it. So just
Interesting.
stay to that and use professional advice. Help them let them take the emotion out for you and really rely on them for the long term. I know that's a great
Yeah.
commercial maybe for you as well, John, but I do believe that and I practice it. So
It's actually been amazing over my couple of decades in this business how many people I see in the finance industry or in the investment industry, they rely on other people to do their own
absolutely.
portfolio. Like it is
Yep.
shocking to me.
Yep.
And even financial advisors, like most of my best friends are financial advisors. And even though we might manage our own portfolios, we all get together on a pretty regular basis and we're always pitching each other on ideas like what's going
Yeah.
on in your portfolio? Am I on the right track here with what I'm doing? We all kind of inherently need that emotional backstop because if
Yep.
we're true DIYers on this, we can be susceptible to making mistakes. So you got to strip it out somehow. It's
Absolutely.
amazing.
I
Everything
agree.
from like
It is.
portfolio managers and CEOs. It's wild how many people
Yeah.
use other
Yep.
advisors.
Yep.
Yeah.
And that's a telling lesson, right? When you know all of the information that's out there, how you can get driven down rabbit holes, how you can have blinders on. I just think that the guys I work with, they give a broader perspective, things I'm not thinking about all the time. So it's good.
Yeah, that's a great infomercial for what we're trying to do.
Yeah.
So outside of markets, what's keeping you grounded when volatility is high?
Outside of markets, meaning,
Yeah, like what's keeping you kind of on the straight and narrow as you go through life outside of just dealing with markets?
oh, you know what? That's a good question. I appreciate you asking that. I try to be grounded, and I am a fairly simple outside of investing person. Maybe some would argue I'm simple when it comes to investing as well, but outside of investing, you know what? I like to camp. I like to do things that, get you back into nature and kind of takes the noise away. It used to be when I find campgrounds and I'd say, I have no Wi-Fi, I have no roaming. And then I realized that's the best thing that could have ever happened to me. So I like to get away. I ride a motorcycle. I like to camp. I like to cook over an open fire and just kind of get back to simple things where, if technology goes sideways, it's okay for a couple of days. It keeps me pretty happy if you want to know the truth.
That's pretty fantastic. Yeah, everybody
Yeah.
needs something. You need a hobby, right? I think about this a lot with our clients. Like retirement can't just be like you quit everything cold turkey. You need stuff to give you purpose. So
Yeah.
that's wonderful.
Well, listen, I got a dog, John. I just
Okay.
recently got a dog, and that might have been one of the mistakes I've made because he is an active dude. But yeah, so I'm trying to have those simpler things that bring happiness, regardless, nothing like a dog coming and greet you, whether good, bad day, raining, no care in the world, just happy to see you. And that's a good grounding as well.
That's fantastic.
Yeah. Well, we'll see if it's fantastic or not. But
I've had a dog in the past. I don't know. I'm
yeah,
currently in a no dog phase, but they are pretty wonderful companions.
yeah. Once they figure out how to live in a house, I think we'll be better.
That's great, man. Well, I
Yeah.
appreciate you, Dave, taking the time.
That was great. It
I'm
was fun. Thanks.
Yeah, I'm going to ask you to keep on for a second here, and I'll just stop the recording.
Okay.
Thank you so much for listening or watching today, and please find us at helmfinancial.ca to connect with me and my team. Information in this podcast is from sources believed to be reliable. However, we cannot represent that it is accurate or complete. It is provided as a general source of information and should not be considered personal investment advice or a solicitation to buy or sell securities. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters. The views are those of the author, John Helm, and not necessarily of those of Raymond James Limited. Any investor should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Securities-related products and services are offered through Raymond James Limited, a member of Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member of the Canadian Investor Protection Fund. Raymond James USA Limited advisors may only conduct business with residents of the states or jurisdictions in which they are properly registered, and Raymond James USA Limited is a member of FINRA SIPC.